specializing in apartment buildings, but we do other commercial real estate from a brokerage standpoint and from an investment standpoint. We also do syndications and asset management for commercial real estate. I started in the business, as I was just saying, in 2003. And I started actually as an investor before I was an agent or a broker. And I got also into raising capital for a couple of investment firms. And then in 06, I got into sales because it was easy. It was easy money in those days. From about 06 to the end of 07, things started getting a little rocky in 08. And I started my company, Infinity, in 09, in November 09. I got my brokerage license. And, you know, I was in an office where it was mainly residential agents. I'm selling apartment buildings. It was a tough time. I had a few guys with cash that were buying stuff. So I was like, you know, hey, I'm not getting business from the brokerage. It's been good, but I'm an entrepreneur. It's time for me to, you know, start the company. And it was an opportune time, but I got to tell y'all, it was a very, very trying and difficult time. You know what I mean? In that time, it wasn't like now. The interest rates are high, but lenders are still lending. They have money to lend. In those days, it was a lot of lenders bankrupt, went out of business. They're working on your file on Monday, and on Wednesday they're out of business. And or they'll tell you, hey, we can do this, and then nah, we can't do that. You know what I mean? So there was a serious credit crunch that was different. There are some similarities that we're seeing now, but it was absolutely different. However, it was a great time to start a company. Great time to do deals. I saw a lot of people make a lot of money. And fast forward to today, you know, from November 09 to today, we've helped a lot of people, you know, make money buying and selling. We've syndicated some properties. We use a lot of creative financing, which I'll be talking about tonight. Creative financing, which I think is big. Well, I know it's big right now and in the next few years. And, you know, we're looking to grow and expand our company. We're based here in Oakland, looking to open up an office in Stockton in the very near future. I just purchased in May a 40-room SRO property right downtown Stockton that we're going to be renovating in housing. We also have 7,500 square feet of commercial space right smack dab and what I feel is the path of progress and urban renewal there in downtown Stockton. So that's a little bit about me, about the company. I've done some things. I have what's called a CCIM designation that stands for Certified Commercial Investment Member. It's a designation in commercial real estate. You got to take some classes, but more importantly, you have to show a portfolio of business experience before you can even take the test. So it's a really good designation, but more than that, it's a network of people like you all, right? Where like-minded individuals get together. You know, in NorCal, I was the first Black president of that organization in 2018, and it was a great opportunity to network. And also, I served as president for Associated Real Property Brokers in Oakland, which is the local chapter of NARAB, National Association of Real Estate Brokers, the Black Brokerage Association, and I was a state chapter of that. Saying all that to say is this: networking is a key piece in real estate, right? So what y'all doing here is a very, very important part of growing and expanding and doing business, because you come somewhere, you learn something, but more importantly, you connect and you network with the people that you're learning from or learning with. And so that is the key, y'all. And so, you know, I'm going to be, you know, brief. I've got another, I got to go downtown Oakland to a mixer. I told Tasha I got about 30 minutes to share with you guys what I know about creative financing. And so, you know, we're going to go over a couple, you know, principles, a couple strategies. And then, if you know, y'all have some questions, hop in, ask away, you know. And Tasha, if there's anything in regards to creative finance that you want me to cover, you know, let me know. I just was going to kind of give a broad reasoning for why I think that's the way to go right now. And there's a few techniques and strategies that I have used, and I'm using. But is there anything particular that you wanted me to cover for the group?
So I do have a question. So I was gonna wait, but maybe it's best for me to say it up front, so that way you can like integrate it in your conversation. So one of the things, we saw a property where it allows you to do to assume the loan, right? And so I wanted to know about what that looks like. have you done that? And what we should know about that going into trying to assume a loan, because this property had like 90 units. And so it was pretty expensive, but is that a good route to go? Is it better to go? What's the pros and cons of that? And then also, are there creative ways to assume loans, or is it just a straightforward thing? And then what are some ways to do that? So, and then also another question that I had is, I thought I knew this answer. And then when somebody asked me, I was like, I feel like I should be able to flow it. And so I want to flow it. And so what is the difference between a joint venture versus a syndication?
Yeah. Okay. Great question.
So
Great question. Well, okay. A couple things. As it relates to assuming a loan, yes, I've done that. This is the perfect time to do that. You mentioned a 90 unit. It might even be the same property. A really good friend of mine is marketing a 90 unit building in Sacramento. This came on the market. His name is David Peels. It might be the same property. And the big kind of selling angle or the pitch, where the thing that makes this property unique and marketable today is that it has an assumable loan. And you can go in and assume that loan at 3.25%. Wherein so this is why this is an outstanding strategy for right now, is that commercial loan, apartment loans right now, mainly in the mid to high fives, low sixes. I've seen something in the low fives, but most rates are going to be in the high fives and low sixes, right? And that's kind of similar with single family homes. In fact, this has been the only year where I've seen consistently residential single family 1 to 4 unit loans are more expensive from a rate standpoint than commercial loans. Only era in time that I can remember. I've been around since 03, but I mean, I never seen that before. So the rates are very similar, right? So if the market is at, let's just say 5.5, that's a good loan right now, really good loan. But if you can go on and buy a property where you assume the loan at 3.25% interest, now you are beating the street. The street's at 5.5 market, and you at 3.25, right? So now inherently that property has a little bit more value than if it was just being marketed where you had to go get new financing. So that, in other words, you can generate a higher rate of return on that property because the cost of the debt is lower than what you were paying the market, right? And that particular property, I don't know if it's the same property or not, Natasha, that particular property is being marketed at a 4.9% capitalization rate. I don't know. You guys in multifamily studies, so you guys are up on the term capitalization rate, or do I need to break that down?
No, you're good.
Okay, so then we all on the same page. So as you can see, so look at it like this, right? If you can buy that property and now you are acquiring it at a 3.25% interest rate, and the property generates a 4.9% cap rate. Now you're cooking with grease, like I like to say. You have what's called positive leverage, meaning that you're making money on the bank's money. You're making a spread. You're arbitraging, you're making money on that. That's what we want. The challenge in apartment buildings, the challenge in commercial real estate, I would, single family flip business is a little bit different, but 2 to 4 units or it's 1 to 4 unit rental, we're all kind of having the same challenge, is that the interest rates are higher than the market cap rates. So that property that you talked about, this 90 unit, you can buy it and make positive leverage. You're probably going to make 5.5% cash on cash. When you make a down payment, you're probably going to make 5.5% of it. Now, let's say you went into the market and you bought the same building, but you had to get 5.5% interest rate loan, right? Amortized probably, maybe it's interest only, but 5.5 nonetheless. And the building is generate 4.9%, right? Now that's a negative leverage situation. Even if the property is positive cash flow, because remember, you're going to have to put at least probably 35% down. So you still could be positive cash flow possibly, but you got negative leverage. And so when I say negative leverage, meaning that I'm losing money on the bank's money. The bank's charging me 5.5%. The property yields 4.9%. And probably that 5.5% also have to be principal paid out amortization. So the cost of that loan is higher than the yield of the property. So we're losing money, negative leverage. All right. All things considered, you want positive leverage on it, where positive leverage is the property is yielding more than the rate on the loan. So we're making money on it. And that's the whole name of the game. So yes, if you can assume a loan, you want to assume that loan, and that's why. Now, assuming a loan is the formal assumption process. You got to go to the bank. Typically, you're going to pay in commercial, you're going to pay 1% assumption fee. So it's not without a fee. And they want to qualify you. They already know about the property. So they don't need to go and qualify the property. They already got the loan. That's what's different about assuming versus getting a new loan. You get a new loan, they got to come, they got to get familiar with the property. They got to order appraisal reports, all that. And they're going to evaluate you. In that situation, you can assume a loan. Now you just got to come in with your financials, your credit, all that, right? That's the traditional way. There is another way, two other ways actually, to assume a loan, a little more creative, right? Where the bank ain't got to know about all that. All right. First way is taking it over subject to. Now, a subject to is more prevalent in residential, in the residential world. I don't really know why, but it is. Meaning that, hey, say the property's $1 million and there's a $700,000 loan, and you come and say, hey, look, well, you know, and oftentimes it's not that. And it's more like there's a $900,000 loan. Maybe they're in trouble and it's $1 million. You come in and, you know, get them out of trouble and you put some money down, but it's putting 10% down versus 30%. That's typically in these scenarios. And then you take over the loan subject to the existing terms, meaning that the deed transfers to you. The deed now is yours. It's your deed. It's not a lease option. It's not a contract for deed. The deed is yours. But you've taken over the property subject to that existing mortgage. The mortgage stays in the name of the seller, and you got to make payments on the seller's behalf. There's a little bit of risk involved in the seller. So typically this happens when people are behind and they're like, hey, this is my last resort, right? Because there's risk on that. If you stop paying them, the bank forecloses and it goes on their credit. They take the property and you lose your money and you lose, you know, the opportunity of making money, but it's on the seller's credit. You know what I mean? That's taking it subject to. In commercial, what's more prevalent is what's called a wraparound mortgage or an all-inclusive deed of trust, where it's the same essential idea, but this is where we actually create a new first mortgage, right? Let's give it the same example, $1 million property, $900,000 loan, right? Well, what we would do is go out there and take maybe create a $950,000 first, just give you an example. Maybe it's 910 or whatever it is. It's an amount that's a little bit more than the existing loan. So let's just say the loan existing is 900. We do the deal for $1 million. We give them 50. We bail them out. We have them take back a wraparound mortgage or all-inclusive deed of trust. That's the technical DRE term of 950. And the seller gives, or we give this mortgage to the seller for 950. That it's a first position deed of trust that then wraps around. It wraps around. That's what we call a wrap around the existing first mortgage, right? It's very, you know, sophisticated tool. So at close of escrow, the deed transfers to the buyer. So the buyer has the deed, right? And this all-inclusive deed of trust or the wraparound mortgage now wraps around the existing finance. So what you do as the buyer, or if the buyer does, is pays the seller a mortgage payment on the 950. They take that payment, they make their mortgage payment. They should make a little bit of a spread. Sometimes it's just dollar for dollar, but you know, if I'm them or I'm advising them, I'm making sure they're making money as well, a little bit. So you pay them, they pay the bank. Again, the bank don't know about this because the banks have what's called due on sales clause in 90% of their loans. I think 100% of residential loans, but almost 100%, not 100% commercial, but mostly. And so if they know that the property trades, they want their money. So there's risk involved on both sides. because the bank finds out, hey, you guys did this deal, and hey, property sold, we want our money. They can potentially do what's called calling the loan due. But they usually don't do that if they're getting paid. They usually only do that when they don't get paid, right? And so those are just two very creative ways to do an assumption that are essentially you're assuming the existing financing, but the bank ain't got to know all about it, right? It is legal. In fact, all-inclusive deed of trust is on your real estate. If you're a licensed real estate professional, you probably saw that on your exam. If you're a real estate broker, you definitely saw that on your real estate exam. That is an actual legal thing. Just because the bank makes a policy doesn't mean it's against real estate law. Keep that in mind as we're talking creative, because this is creative mean, hey, the bank ain't giving us money. The bank is charging 7%. The bank gets their money from the Fed at 2 or 3%, and they're charging us 7%. So, we're doing what we got to do to make deals happen, right? So don't confuse real estate law with banking policy, right? They make their own policies and rules that ain't necessarily the law. So we can do things like wraparound mortgages subject to. We're not breaking the law. Agents and brokers, you good in terms of your licensing and all of this, but it's just a creative way to get a deal done. All right. Now, quickly on syndications versus joint ventures. Joint venture more than anything is a term. The structure of that joint venture is going to be not called it's probably going to be an LLC or a partnership agreement or something to that effect. But the basis of it is we are joint venturing into a deal, meaning me, you, or whoever the parties are, we are coming together kind of like partners, and we're working the deal together. All right. Syndication is where the sponsor, the group, the person who it is raising the capital from the investors is like the general partner, if you will, or managing member of the LLC. If it's an LLP, that would be the general partner. LLP, limited liability partnership. LLC, limited liability companies. Kind of the same, but a little bit different. The sponsor is either the managing member or the general partner, the one who puts the deal together. They go out there and put the deal together, find the property, obtain the financing, sign, personally guaranteed most often for the financing. And then the investors are limited members or limited partners. Their investment, their risk is only limited to the money they invest. They are joint ventures. We all in this together. If something goes wrong, it's on our credit too. You know what I mean? Somebody sues, they suing us too, right? But we also have a little bit more of management say so. In a syndication, you may have voting rights, and a lot of times, unless it's depending on the syndication, you may not have voting rights. But most syndications, you actually do have voting rights. If it's a fund, you don't have voting rights, right? But it depends. Either way, though, in a syndication, you are a limited partner or you are a limited member. You're not calling shots. You are not liable outside of your investments, and you are not part of the entrepreneurial brain trust running the project. The joint venture, you are. So those are the two fundamental differences. Joint venture, though, can take many different forms in terms of how it's structured. It can be an LLC, it can be an LLP, it can be a TIC, it can be a DS, it can be whatever, but it's just joint venture, meaning that the people putting this together are coming together as kind of like partners in the deal, not as a passive investor. That makes sense?
Yep. Anybody have any questions there? Chris, you look like you got a question.
No, it's not necessarily a question. It's more so my understanding of what he said, as opposed to the various different things we've heard. In order to do the syndication, they can't just ask random people for money. They have to have certification or something to the effect of 506 something, I think was the term that they taught us in the multifamily class.
A 506 Regulation D or C offering. And what that means is you have to have a pre-existing relationship. You can't mass marketing, right? And that would be whether syndication or joint venture, you're not able to mass market it unless you register it in a certain way, right? And there's that's you got to register your like 506 C or D is a kind of a non-registered security. If you go through the whole process of registering your security and following certain rules and have a certain private placement memorandum. You could do like what Jay Morrison has done. I don't know if you guys know who Jay Morrison is, but Jay Morrison runs the Tulsa Real Estate Fund. It's a young Black dude who started this Tulsa Real Estate Fund, and it's I want to say a series 2, and I could be wrong with the language, crowd fund. In that type of structure, you can mass market, and the investors do not have to be qualified. For most of what we're talking about, that's not so feasible, right? If we're doing a basic syndication, it's going to be a non-registered offering. It has to follow certain rules. The investors, you have to have a pre-existing relationship with someone. It can't be mass marketed. And then the investors must be accredited investors. Accredited investors is essentially a person or a couple making $200,000 a year in their taxes, and or they can show $1 million net worth outside of their, as of 2012, outside of their home residence, which in California sucks because a lot of us have, if you own your home and you owned it for a while, you got a lot of equity in your house. Oh. And so a lot of people could qualify as millionaires or $1 million equity with their home. What happened is a lot of people in the Great Recession or in a great financial meltdown, whatever, a bunch of people had invested in deals and they were not accredited, but they had, I mean, put it like this, they were millionaires, you know, in terms of their equity, but they were not necessarily sophisticated in these things. And so when they lost it all, the government came in, and, you know, when the government comes in and they regulate, they over-regulate. And then they said, hey, only people who are accredited can invest in these deals, and they have to have $1 million net worth outside of their home residence or make $200,000. So that's kind of the qualifications that you were saying there, Rich, in terms of putting together the offerings on your syndications. Now, for joint venture, it's just you and 2 or 3 buddies or whatever. It's not a syndication. You guys are coming together as partners to put your resources and money together to make some things happen. It's a little bit different. Syndication, you say, hey, look, we're raising a profit. Give you an example. That's what I'm doing right now. We're buying an 8-unit REO in Oakland. It's an REO, first REO, real estate owned by the lender, first one I've seen in years. All right, we're buying it. And we got a 70-30 split. I'm 30% as a sponsor. The investors are 70%. We got a total $400,000 raise. It's broken down as $25,000 increments. And that increment was called a unit, right? And so everybody who invests in a unit, they will be a limited member in this syndication. They will have voting rights. They'll be part of the management decisions. You know, they're not silent partners, but they're not burdened with having to do all the heavy lifting of running the building and running the complex and all that. I got to make sure anybody who comes in that deal, we have to have a pre-existing relationship where we met somehow, cultivate a relationship. You know, like I do seminars. When I do my seminars, I don't pitch a deal. I teach on a topic. And then if people are interested in coming about doing business, we also broker property. So we're not pitching my listings at my seminar either. We're giving knowledge and we develop a relationship, right? And through that process, we've developed some great relationships and have people invest with us on syndications, broker deals for them. And it's a great way of doing business. So you have to do that, you know, in some way, shape, form, or fashion. You can go and do the crowdfunding route, but that's very expensive and it's a lot of management. Jay Morrison has done that, and they're still in business and they're still out there. You know, he's real sophisticated. He has a big following online, and his mission was also, hey, I want my community, the Black community, that's why he called it the Tulsa Real Estate Fund, and trying to build back Black Wall Street. That's his mission, that's his vision. So you could get in his fund as little as $500. You don't have to be, you know, accredited. So that was his mission, that's his vision, and he's serving a need in the investment world for sure, blazing trails. Now, it's a lot of management. I don't know how many investors he has, but he has hella investors, and that's a bunch of management. You know what I'm saying? So for our purposes, you probably don't want to start off like that, right? You want to probably start off something simple, basic, get your PPM or get your, like we're using a subscription agreement on the deal. Simple, basic, get it going that way, right? And so that's just the difference between syndications and joint venture. But I think the similarities of those two structures of creative financing in general, syndications, joint ventures, is utilizing other people's money to finance a project. other investors, the seller's equity to finance a deal, right? And meaning that we don't just have to depend on the bank to make a deal happen, right? But and I just got a few more minutes, probably go to about 7:50, but I wanted to share with you guys a few of the strategies, a few of the creative financing strategies that I have used, that I teach and I preach, that we are closing deals with now and have closed deals in the future, and strategies that I'm going to employ. We talked a little bit about wraparound mortgages, so I already covered that, and I was going to hit that. The first thing is traditional seller carried first and second deeds of trust, right? In California, we call them deeds of trust. In other states, they call them mortgages. It's the same thing. First meaning first position, second meaning second or junior to the first position. You even have a third position mortgage. If you all the positions just have to do with who's in priority. First position, the senior lender is always in priority. That's basic. Right? So give you an example of a deal I just closed as a broker. We sold a commercial property here in Oakland, and vacant retail needed a bunch of work. Ain't nobody buying that property on the market. We try to market when it happened. But we structured a deal where we got it done to where the seller carried the first position mortgage. Now, they did not own this property free and clear. They had about $200,000 of debt they needed to pay off. And they was getting some pressure from that private money lender because they was owed their full payment years ago. And they're like, hey, look, we need to get paid. Y'all got to sell this property. There's no income coming in, right? Very difficult sell for me, right? Interest rates, 5.5%, 6%. That's a very difficult sell. So what we did is we structured a deal to where the buyer could come in. They came in with 200 grand down, right? And some change, closing costs. So, and then the seller carried the balance, the first position mortgage, at 3.75%. Now, what that did is incentivize the buyer to come in with that nice down payment, right? Because a lot of people don't want to buy property. A lot of people scared to buy property. And they should be, this is the time to be aggressive and to go after stuff, not overpay being aggressive. That's not what I mean, but I mean, look for properties, make offers, be aggressive, right? Now is that time, y'all, by the way. And so what we did was we structured the rate at a lower than market interest rate. So that entices the buyer to say, here's my $200,000. So with that, at close of escrow, the seller paid off their loans, their liens, that city Oakland liens, blah, blah, blah. Now they got a stream of income that's going to be coming in on the property. We gave the buyer a little bit of a grace period for them to fix up the property, find a tenant. But then they're going to be making a stream of income. Now it's 3.75%, but is the bank paying 3.75%? No, right? They wasn't making no money owning the property in this instance. And so now they take, and they don't have a big tax hit because they're carrying the financing, right? So that's something that's first position. Here's what I did on the deal in Stockton that I closed recently in May. I had a seller carry second. So we bought the property. If many of you, I don't know if you know Stockton, 445 East Main Street. It's a historic building, made a great building. We bought it for $590, right? Great deal. 30,000 square feet, 40 rooms, 7,500 square feet of commercial space. We went out and got a loan, first position, 65% of it. Now, I wasn't really thrilled about coming in with 35% down plus the closing costs, and I'm gonna have to pay holding costs until we get it renovated. So what I proposed to the seller was, look, why don't you carry in second position? So that way, when we close, you get most of your money. Majority, you get a big lump sum. But I'm asking you to help me out here. You carry the second, and they carried the, 20% second, 20% of the purchase price. So that brought me to 85, and I came in with 15% in the closing. And what I came in, I had a couple of my buddies, kind of similar, more like not really a syndication. A couple of buddies of mine came in as investors, and we bought them. More kind of similar to a joint venture. And we closed that escrow. I came in, I mean, out of pocket for me was like, I think like 25 grand. I put into the deal. We bought a, 590 property, 90,000 property, and I got a commission on it, right? So it was a sweetheart deal, but more than that, it boosts the rate of return for the overall deal because we've got less capital into the deal. We're not over leveraged. We bought it right. When we renovate, we're looking at making, 40 to 45 G's a month in rental income. And what's going to be a nice, and that is a way that the seller got the majority of their money at close of escrow. 20% of the deal they carry back. In a second, is there risk on their part? Yes, because they're behind the first. But that isn't the case that you can use that strategy if they need their money. Right? Sometimes people need money, close escrow, right? Okay, so that's number one. Traditional seller carry first and second deeds and trust. That's going to be most of what you do when you're having a seller carry. Now, we all heard of lease options, right? On commercial or multi-unit, any duplex and up, or anything commercial, we call it a master lease option because you are leasing the entire space, the building, versus one space. And if it's a single tenant commercial property, that would be a regular lease. But if it's multiple tenants, multiple units like apartments, it's going to be a master lease. So you are a master lease. You're leasing the entire building, right? For an amount. It's a lease, master lease, right? And at close of escrow, you do not get the deed. Okay, we talked about all-inclusive deeds of trust, assumptions, you get the deed. Subject to, you get the deed. Seller carry first position, you get the deed. Second position, you get the deed. Master lease option, you do not get the deed, but you do have a form of ownership. It's called equitable title. That means I have rights to the title. So long as I follow through on the covenants of the lease, and then what is accompanied with that lease is what's called an option agreement. Just like if you're familiar with the stock market, it's an option. It's a right, an option to buy the property at a certain price within a certain period of time. Now, there must be a certain period of time. There does not have to be a price. You can negotiate market price, but that is, that could be a risk. It's advised to negotiate a price. And you kind of want to have an idea of what's going on with the market, right? If you negotiate a price right now, you have to be aware that price may go down. So if you're negotiating price, you need to make sure you negotiate, right? But you do not have to have a price negotiated. You have to have is a period of time negotiated. That is the option period. So you get a master lease option. It's typically for 1-2 years. It could be 3. It could be however, whatever you negotiate. You want to give yourself a long enough period of time to be able to find financing so you can close it and buy it if that's what you want to do, or you can fix it up and you can resell it. You know what I mean? You can do that. You can, as you own the option rights to a property, you can sell the property because you have the rights to buy it. You can sell those rights to someone else, right? And they can buy it and you can flip it without even owning it, right? But most of us are looking at buying the property. I mean, you could do that, make some money. But this is a great way for you to get into a property, very low money now. Now, there does need to be a little bit of money down. That money is called option consideration. Typically anywhere from 1 to 3% of the purchase price. I would not advise going more than 5% of the purchase price, but it can be as little as $1. The first deal in my real estate career, it was 2003. I was 21, right? Yep, I was born in 82. I was 21. I had master lease option a 6-unit building in Pueblo, Colorado, for $300,000. We had the right to buy the property for $300,000, and we did that deal with $1 down. It was $1. That was the option consideration. There must be something. Be a quarter, be $1, but it got to be something to bind the contract of that option. You know what I mean? It could be a promissory note. If you ain't got, I did my first deal with $1, and I literally had to borrow $1. I was with my dad, you know what I mean? And this is a funny story. We go and he let me do the whole thing. I said, Dad, I got this. I'm gonna negotiate this. I'm gonna do it. I got it. He was proud. Dude agreed. We signed right on the spot. And he was like, you know what? We're gonna do this, no money down, but I actually need $1. I was like, cool, all good. I looked in my pocket. I didn't even have $1. You know what I mean? I was a student at San Jose State. I legit did not have $1. I wouldn't even think about that. I had to go to the truck. I was like, hold on, Mr. Seller, I'll be right back. And that's a real story, but it had to be something in order to bind the contract. So, I mean, it was pretty much no money down when we made that happen. So that's a master lease. Now, another thing with the master lease, you want to try to negotiate a portion of the portion of the lease amount that you pay every month to be credited towards the purchase price. So what that could do for you is that can act like your principal pay down of a mortgage. You know how you make a mortgage payment, a percentage of that mortgage is going towards the principal, right? Mm-hmm. So anywhere again between 1% and 5% is a number. That's the Wild West. Whatever you can negotiate. Some sellers don't want to do it. I've done it where sellers like, nah, I ain't asking. But it's a reasonable request. A lot of people ask for it. A lot of people get it. And also remember, whatever your option consideration is, that also gets credited towards the purchase. Now, let me tell you the risk. If you do not execute that option during that period of time, you lose that option consideration. It's gone. So, you know, it's not like a deposit where it's refundable for a period of time. You release the contingencies and then it's not. Nah. Up front, you are purchasing an option. It's not an earnest money deposit. It is an option consideration. Yep. Rich, that question?
Yeah. So I've worked on smaller, what I call creative financing, which would be leveraging business credit cards to pull money off of business credit cards and acquire the asset. So typically in the same model that we would think of, whether it's a joint ventureship or some form of not even a syndication, I wouldn't even go that route, but if it's a joint venture, say the amount of people that's on this call right now, right? Say we all have access to $100,000 of business credit. We liquidate the cards through the methods I know how to do, and then we go acquire the asset. Now, of course, these credit cards would give us 0% for a matter of 12 months and some at the max 20 months, right? But then when that's due, instead of doing other strategies like, which is carrying or consuming the debt with another line of business credit cards, which is creative, which we could do, but after a year of having whatever the asset, whether it's an asset that we're going to hold, which is a rental property, what would be an approach that we would take in terms of assuming the entire debt, considering it would be a brand new organization or institution, having a year on the books with this asset, with the rent rolls showing that we're generating revenue. What type of funding would you recommend for that scenario?
So are you okay? Let me see if I follow you. So you're saying you get the business credit cards or line of credit, whatever it is, and you take the dough out of the cards or the line of credit. You use that dough as either your down payment or
no.
Pay cash.
I'm talking about buying it straight outright.
Got you. So you take out the amount and you pay cash for the property, right? That's what you saying?
Yep.
And then are you saying now that you paid cash for the property in order to re-up or pay off your credit cards, what is the best method of financing at that point? Is that what you're asking?
Yeah, because we would have. So let me, because it sounds like you're tracking, but let me make it a little bit more clear. So at the end of a 12-month period, that interest rate, which would have been 0%, would have converted to the actual interest rate, which would be 14 or 22 or whatever that interest rate is for those particular cards, right? So we've got multiple investors that have done, we've all as a group have done this particular process. So we're all looking at 12 months, we've made revenue, we've got money coming in, we've got this asset, but now these interest rates are going to transfer into what they're going to be. And so assuming the entire asset or the entire loan or the money that we've got out in order to get our cash back, right? Because if we bought a $1 million asset or a $2 million asset, that's a lot of money that would then convert to 22% of interest, right? And so what would be, like I said, what would be a strategy or what type of loan would you think, or will we be trying to sell it to another entity that we've created, or how would you go about doing that?
Well, I mean, at that point, one or two things, right? Because you're probably not going to be able to service 14% with the rents from the property, right? And I would think you probably, if you were to use that strategy, you probably want to do a flip type property. But let's just say if you used it for rental and you bought it for the rental income, right? And you first year, good, because it's 0%. So you, make a straight profit, right? Now when it converts to 14%, now it's like, oh snap, now we lose money. Well, the short answer would be to then go put a mortgage on it. The mortgage is not going to give you 100%, but hopefully, that's why I said it's probably better to do that strategy on a flip. But say you bought a property, was undervalued, put some paint on it, carpet, rented it, or had a bunch of vacancies, right? And you kind of leased it up. And now it's got a pop in value. And you go and you refinance and say, hey, I want to do 70% cash out refinance and, take that cash out and pay the cards off. And you may not be able to pay them fully off, but you certainly can pay them down, right? And then, and maybe, and say you got say that you didn't get that pop in value, right? And you went to the property, now you got a 70% loan on the property. Somebody's going to have to go get that loan. And then now you can at least pay down the debt 70%, and the 30% that you're paying on, you should still be able to deposit. I would think that is a way, that's a way to go ahead and do that right there. You know what I mean? However, if you're going to do that, I think that's probably better suited for a flip deal or a deal where you're going to value add, you're going to reposition it, create equity so that you can bring in financing. Now, the other thing you can do is just sell it and do a 1031 exchange into something else. Sell it, pay the cards off, right? Take the equity and go buy something else. And then that way everybody's read up. You got your cash, you got another property, and you got the cards or lines of credits paid off, and you can go do it again. So just, that's just something that you could do. You know what I mean?
Yeah, and those type of deals I've typically done with flips. Meaning
yeah, exactly. So I think because with flips, you got 0%, man. That's because you can get in and out within a year. You should be able to get in and out. And then re-up, pay it off, man. Keep doing it. You know what I'm saying? And that's a creative way to use the bank or the institution. You know what I mean? Which is, we could sit here literally, y'all, for and I do got to get going. We could sit here literally and talk for 2 hours about creative finance. And that's the thing that gets my juices going, because a lot of people in the real estate, especially agents and brokers, get stuck into this world of the bank. This is all we can do, the banks. You know what I'm saying? And we just talked about 5 or 6, 7 different ways that we're not talking to the mortgage banks who are trying to jack us and all this stuff. You know what I'm saying? If you can get in a deal with 0% interest, hell yeah, make that happen. If you can assume a loan at 3.25 and everybody else is at 5.5, you win it. If you can get the seller to carry in the second position and you only come in with 10% or no percent down, you know what I mean? Hey, you're in a great position. You know what I mean? Or if you got some dough, but your credit is whooped. Or let's say, for instance, you may have excellent credit and you have a down payment, but you want to buy a value-added property because you guys been studying multifamily, right? Y'all all know the importance of value add. You buy a property, you get NOI, right? That's how we make our money. The bank ain't financing that. So hard money will finance it, but hard money is going, that's another creative find with hard money. They call it hard for a reason. You know what I mean? If you can negotiate with the seller and present to them, the seller, you guys, is in all of this stuff now, our best way to finance a deal, I think, over the next 12 to 18 months, because most of the buyers in the world they're not. I'm telling people right now on deals, I got 7 listings right now that are just kind of sitting, right? And we're dropping prices as a broker. And I'm like, look, it ain't selling because the market ain't paying that. It's just that simple, because I do YouTube ads and emails and cold call. I got cold callers working for me that pitch my listings. It just ain't selling at that price. And so when I'm talking to people, is you got to do one or two things. You want to sell your property. You got to lower the price, or you're gonna have to carry some paper. It's just, if you want to sell, you could sit and not sell, just rent it out, but you come to me because you want to sell, right? And if we're gonna get this done, we got to think outside the box. And a lot of sellers right now are holding because they're like, hey, they're gonna lower their interest rates in January. Everything's gonna come back. I can't tell you how many people think that's gonna happen. They might lower the interest rates in January, 0.5% or a 0.1%. They're not gonna lower them at the rate in which they just raised them. That would just completely undermine everything they just did. They're trying to fight inflation, which is a real thing, by the way, y'all. That inflation ain't playing. So they have to finish the job. So they may lower rates. I hope they lower rates. But it ain't gonna be we in California where 1% of $1 million is $10,000. Break that down, it's about $833 a month. So that's a lot of money. You know what I mean? Now you bring that down to wherever price point you're at. And that's real. So that's why the market is on ice for right now. But the sellers are holding strong. They're holding, but it's going to be a point where they like, hey, I need money, or I need this off of my back. I'm in the great city of Oakland where you can't evict nobody. You know what I mean? So you better hope you got some Section 8 or some quality tenants, because if they decide to stop paying you, you can't get rid of them, but your mortgage, they can foreclose on you. So we're seeing the backlog of that, show. So as I conclude, look to the seller to help you to finance these deals as much as you can. And then go to the assumptions, the lines of credit, the cards, because sellers are going to be more, and you will find this, they're going to be more and more flexible and willing and able to carry financing to where we can get deals done. And I've done all the stuff I talked about are stuff that things that I have done either as a broker or as a principal. And a lot of agents and don't understand how they can get paid. And so and then a lot of agents don't understand this. And so as part of one thing I do as a broker, I try to educate my team and my staff, also the marketplace on, hey, this is how you can do a deal and get paid, maybe a little bit less than you was gonna get paid, but hey, 100%, a little bit of something is always better than 100% of nothing. And especially in these times when the values have not plummeted yet. I don't think they're going to plummet. I think they'll come down slightly. And they're in my space, they have come down. Residential, not so much, but they're going to come down a little bit. But the transaction volume, the amount of deals getting done has dropped off a cliff compared to where they was. Right. So we as brokers and agents, we eat off the transactions. You know what I'm saying? This is investor time. Investors are going to clean up now. And agents and brokers, we need to be, a little flexible in how we do things so that we can make money. So that being said, I got to get rolling. I really appreciate it. Is there any questions before I mouth? I do got to get rolling. But anything that y'all have for me before I get up out of here?
Stephen, this is Lisa. Thank you so much for your knowledge there. We certainly appreciate it. But you mentioned that you have seminars.
Yeah. Yes.
We would, if you could share that information.
I'll share
your next seminar.
You guys.
Absolutely. So we usually do our seminars on the fourth Wednesday of the month. Now, on this fourth Wednesday of the month, I'm gonna be hopefully in Florida with the fam, chilling, relaxing. But we will resume in January on the fourth Wednesday of the month. We have our seminars here in San Leandro, and it's in the evenings. Be 6 o'clock. But we also live. We also do YouTube lives. So if you subscribe to our YouTube station, so by the way, hit us up on YouTube. It's Infinity Investments on YouTube, or just go Steve Peterson on YouTube. Subscribe, and then you'll get the notifications when we go live. But look forward to the fourth Wednesday of the month, 6 p.m. And I'll definitely let Tosh know and send Tosh the link if you want to blast it to the team. And let me know. I'm also, by the way, we will be bringing this to Stockton whenever we get things rolling. We will do our monthly seminars in Stockton some point starting hopefully the second quarter of next year. So look out for that for y'all in the Central Valley. And tap into our YouTube to stay plugged into the content.
Perfect. Thank you.
You're awesome. Thank you so much, Steve. We appreciate you.
No, appreciate y'all. And I wish I could stay long. I got to get going. I'm going through another networking. But look, make sure y'all network, man. What y'all doing here is great. Any way I can support y'all, be a part of what you're doing, and then keep doing it, keep networking, and keep inspiring each other. And let's go make some deals and some money happen.
Yeah.
I'm gonna send
Wait,
Steve.
one more thing.
Hold on, let me say it because real quick. So Steve, I'm gonna send Natasha. We will be in Oakland, or I will be in Oakland, speaking at an engagement for free at Revelations Ministry, and we're gonna be talking about credit, Turo, leverage, real estate, etc. So, and I'm bringing Chase and PNC Bank with me.
Nice.
I will be one of the headliners. So if you have the opportunity on January 7th to come out, we'll make sure that you get a flyer.
Oh, that sounds lovely, man. I'll definitely be there supporting my team too.
Yay. Thank you.
Great.
Katie. I forgot what I was going to say.
Well, you can text me anytime.
I know. All right. Well, go ahead. I know you got to get going. Again, we appreciate you. Thank you for dropping so much knowledge and gems to us, and you got us motivated. Oh, I know what I was going to say. It was a quick answer, but a lot of times I know we get discouraged trying to look at these deals. When you see people trying to do syndications and multifamily, they go through so many before they find the right one first. What is just one takeaway that you would just give us before you leave? Like
look, patience is a virtue. Patience does not mean waiting though. You have to be patiently aggressive. You gotta look at all those deals in order to find the one. You know what I mean? But you're patient in the sense of you have an investment criteria and you stick to it. You don't go outside of that criteria just trying to do a deal. You know what I mean? Be patient, but you have to be aggressive because guess what? There's a whole bunch of other syndicators out there. It's a whole bunch of other funds out there with cash. There's a whole bunch of people who got cash. You know what I mean? Waiting for or looking for these opportunities. So you have to be consistently on the hunt, and you have to be disciplined and patient within that. And that, because the worst thing you can do is buy a property you don't want. I've been there. You know what I mean? If you've been around long enough, probably everybody's been there. You know what I mean? Blackstone, BlackRock has been there. You know what I mean? And so it happens. So therefore, you want to stay disciplined and patient while you're going through this process. But always be feeding yourself knowledge, information. Always be sharpening your axe and do what you need to do. So that's what I would say on that. Just keep on swinging it back, keep on hustling and making it happen.
Thank you. Have a
Thank
good
you so
one.
much.
And
All right,
thank
y'all.
you.
Have a great
Bye-bye.
evening. All right,
you.
peace.
Peace out. All right, guys.
That was dope.
That
I
was
told
good.
y'all he
Yeah.
was good.
That was good.
I couldn't wait to get him on. He gonna come back too. He was like,